Let me ask you, Steve Rashuda, what are the words you're looking to hear, and what would surprise you if you either do hear it or don't hear it?
Well, it's less the specific words than the balance between employment, inflation, and wages. Where does the conversation go in terms of those three topics? Are they increasing their worry about wages versus prices, and how much is dedicated to employment over inflation? So that's kind of the balance you're looking at. The more concern you get on wages, the more bearish it's going to be at the front end of the curve. The more focused it is on employment and the need to fulfill the employment versus the inflation, which they continue to view as transitory, the less hawkish the overall commentary becomes. So that's kind of the balance you're looking at.
Steve Leisman, I don't know whether you're ready, but I'm going to turn it to you anyway, because I know you're always ready. What do the headlines say?
Have the headlines yet, Tyler? If you would just give me a few minutes. They came over a minute late. We are pouring through them at the moment, Tyler.
All right.
Thank you.
I will give you all the time you need, my friend. Alan Boomer, your thoughts about how dramatic. I mean, obviously the Fed has been hinting at, talking about some kind of monetary tightening. How consequential is the kind of tightening we expect to see going to be for the economy, when on the other hand, you have the opposite of tightening in the fiscal space?
You're bringing up a great point, right? You've got a Fed that wants to put a foot on the brake, and you've got a government that wants to put a foot on the gas. Okay, and you got a Fed that wants to put a foot on the brake, and a president that wants to put a foot on the gas, and that creates volatility. It creates. Imagine driving your car with a foot on the gas and a foot on the brake. That's an issue. But going to how consequential is the Fed's plan or the potential for the Fed to raise rates? I don't think it's going to be that consequential. The market's fully expecting that there will be a rate hike. I think the expectation is by the summer of next year we'll get our first hike.
Keep going.
And so again, I don't think the market's going to completely break down when the Fed starts to raise interest rates.
All right. You cannot, as we just proved, you cannot put Rick Santelli in a box and keep him quiet. He's so enthused, he wants to jump right in here. Take it away, Rick.
Tyler, the big story is, and Steve nailed it early this morning, to see how far along and what kind of agreements there were with regard to the Fed prior to some of the information we now know. And what we are seeing is that many said that the taper being faster could be warranted. So that is in there. But they also said that they upgraded their inflation outlook. That's very, very important. But then they downgraded their growth outlook. So let's try to put this together. We've seen people all the way from Mary Daly, Vice Chair Clarida, talking about maybe we need to speed up the taper so we can actually start to tighten rates a bit. And it seems as though the seeds of that could have been planted in the last meeting. And we do see some of the yields right now in the short end going down, and that doesn't seem to jive with what I'm reading, because short rates should be going up if this was considered hawkish with regard to pulling taper forward. So even though it was discussed, it was stressed to be flexible and not necessarily underscoring to be quicker.